Hello, my name is Michael Panamero, President of the Finance Institute. I'm delighted that you took the time out of your busy day to join me here. Welcome to the presentation. A few housekeeping items for you. The first is timing. I wanted to let you know that I shouldn't take more than 20 minutes of your time to deliver this valuable information. And two, if you have any questions, please be sure to write them down. Chances are I will answer your questions with the information I will share with you during this presentation. If I don't, you can email them to us at info@thetfi.com. That's info@thetfi.com. Now, to tell you a little bit about me and how I got here. Prior to joining the alternative financing industry back in 1999, I had established and sold 3 other businesses. The most recent was a detergent manufacturing company that sold industrial laundry and dish powder detergent to industrial wholesalers, distributors. We did some private labeling for retail stores. We exported overseas. And one day we decided to bid on a government contract to supply all the federal penitentiaries their laundry and dish powder. In order to be competitive, I negotiated early payment supplier discounts under the stipulation my company would pay our suppliers in 7 days of receipt of the raw materials. We were successful in winning that contract, but we quickly found ourselves in a big cash flow issue because the government paid us in 60 days for the first order. When I approached the government agent to see if they could pay us faster, they basically told me if my company could not honor the payment terms, there were other companies that could. So I went to the bank to get a loan, but we were declined because we were growing too quickly. My partner and I ended up trying to finance the company and pay our suppliers using cash advances against our credit cards, and we almost lost everything. Until one day I found a cash flow solution that changed how we did business. A matter of fact, it saved our business. From there I started to broker financing relationships on the side, helping my customers increase their working capital. With my success and the feeling that I received from helping business owners solve their cash flows issues, I decided to sell my partnership in the detergent business and become a full-time alternative financing broker. This led to me establishing the Canadian operations for a finance company out of the United States, and in 2008, I founded the Finance Institute. The core mission of the Finance Institute is to make the daunting task of finding more cash flow easier for small and mid-sized businesses across North America when traditional bank financing is not available. We continue to deliver on this mission by delivering workshops, seminars, webcasts to industry organizations, trade associations, chambers of commerce, small business centers, and startup groups. Over the next few minutes, I'm going to share some of the best content and valuable information that you're ever going to get when it comes to creating immediate and predictable debt-free working capital in your business. And best of all, the tremendous amount of solid and pragmatic information you will gain from me during this presentation, you will be able to use it to your advantage immediately after this presentation is over to help your business thrive. So just pick up any newspaper or read any online publication, and you will discover article after article, post after post, comment after comment, addressing the fact that businesses across this country are still finding it difficult to receive traditional bank financing like loans and operating lines of credit. For many small businesses, the bank isn't a bank at all. And the purpose of this presentation is to quickly educate you about a solution that is quickly becoming the alternative business financing solution of choice. But most business owners, most people have never heard about it or know how it works. Did you know that among the top 6 factors that keep a business from getting a small business loan, poor cash flow tops the chart? A recent study by the Credit Research Foundation revealed even more shocking facts, that 82% of all businesses are reporting poor cash flow. The report goes on to read that 92% of new businesses will fail in their first year due to the lack of available working capital, and 100% of all businesses will struggle from slow or no cash flow during their existence. The report goes on to say these companies cite the lack of available working capital, the tightening of cash flow, and the slowdown in customer payments as the three major issues that are having disastrous effects on the viability of their businesses. So, what is the solution and why is it important to a business? Companies large and small across this country every single day are delivering products or rendering services. In order to be competitive, they can't always insist their customers pay COD, cash on delivery. So in addition to providing the product or rendering the service, every business issues an invoice. I recognize that you know what an invoice looks like, but let me bring your attention to an important section of this invoice indicated by this little green box right here called terms. Typical terms issued by vendors to their customers is 2% 10 net 30 days. What does that mean? Well, if a customer pays for their invoice within 10 days of receiving the invoice, the vendor will discount, or should I say the customer will receive a 2% discount off the total value of the invoice. If the customer pays for the invoice after 10 days or before 30 days, the customer is required to pay for the invoice in full. Now, by listing terms on an invoice qualifies this invoice as a legal document or a short-term note. So in addition to providing the product or rendering the service, the vendor issues an invoice and now they wait. What are they waiting for? Well, they're waiting to get paid. They're waiting to get paid 30 days, 45 days, 60 days, 90 days, and even longer. Did you know that the national average for invoices to be paid across North America is a staggering 73 days? And did you know that it's estimated that small businesses across North America carry over $825 billion in invoices at any given time? And here's another fact. The average small business across North America invoices between $100,000 and $500,000 each and every month and now waits to get paid. While these companies are waiting to get paid, other orders are coming in. While these companies are waiting to get paid, they have to find new ways to fill their orders, to pay their employees, to pay their suppliers, to pay for fixed costs, and keep current with their taxes. And this vicious cycle continues to happen every single day to small, medium, and large businesses around the country. So let me ask you this question. If the banks aren't lending and customers are always paying late, where does a business go to get the money it needs to grow or in some cases survive? Small to mid-sized businesses that need the cash flow to thrive are turning to the concept of accounts receivable funding to factor or sell their invoices. Just take a look at these numbers. Now the numbers aren't out yet for 2016, but at a time when many industries have been floundering, the factoring industry has been experiencing explosive growth. And all indicators point to the fact we can expect much of the same for the unforeseen future because traditional bank financing is very hard to come by. Here's another statistic that you should know. It's estimated that there are over 55 million small to mid-sized businesses across North America, but less than 10% of these businesses use accounts receivable funding because most have never heard of this concept before and the many benefits of using it in their business. So what is accounts receivable funding, what is factoring, and how does it work? Well, the definition of factoring goes something like this. Factoring is the purchase of business to business or business to government accounts receivable which are current or outstanding invoices for goods or services that have been rendered in the past for a discount fee. Let me repeat that. Factoring is the purchase of business to business or business to government accounts receivable which are current or outstanding invoices for goods or services that have been rendered in the past for a discount fee. It's important to note that factoring is not a loan, and there is no interest charged. It's similar to a cash discount, similar to that 2% net 30 days payment terms that are usually offered by businesses or vendors to their customers. So how does it work? Well, there's two key disbursements associated with a factoring transaction. The first one is called an advance, and the second one is called a reserve. The advance is when the vendor receives up to 95% of the face value or the total value of the invoice when the invoice is purchased by the factor. The reserve is when the vendor receives the balance once their customer has paid for the invoice in full, less the discount fee, or what we like to call is the factor's fee. To give you an example of how it works in real life, I have prepared the short example for you. Let's say, for the purposes of this example, we had an invoice of $10,000. And let's say that the funding source, the factor, decided that they were going to advance 90% to the vendor. 90% times $10,000 equals an advance of $9,000 when that invoice has been created. When you subtract $9,000 away from $10,000, you still have $1,000 or 10% of the invoice that is still owing to the vendor. The vendor receives this 10% once the customer has paid for the invoice in full, less the discount fee the factor will charge. For the purposes of this example, let's say that the factor determined that they were going to charge a discount fee of just 1.5% for 30 days the invoice was outstanding. And let's say in the perfect world, the customer paid for their invoice in 30 days. So the factor would take 1.5% times $10,000, which is the total value of the invoice, and the discount fee would be just $150. When you subtract the $150 away from the $1,000 that is still owing to the vendor, you will receive $850. So in the beginning of the transaction, the vendor would receive $9,000. At the end of the transaction, the vendor would receive $850 for a total of $9,850, and the discount fee was just $150. You can see that the discount fee is very competitive compared to standard business payment terms. Standard businesses offer 2% 10 net 30. What does that mean? Well, if a customer pays for the invoice in 10 days, the vendor will discount the invoice by 2%. In this example, the factor is waiting an additional 20 days, a total of 30 days, and only discounting the invoice by 1.5%. What are the benefits of using factoring? Well, first, you can obtain cash without creating debt. Remember, factoring is not a loan and there's no interest charged. It's similar to discounting your invoice for early payment by your customer. It's quick and it's convenient, and there's a simple process involved. It usually takes only 3 to 5 business days to set up a factoring facility into a business. And unlike an operating line of credit with a bank, the credit limits increase with the value of your sales. For new startups all the way to established, you can extend credit terms to increase your sales because the factor will be advancing money up to 95% of the face value or the total value immediately after the invoice has been created. There's no long-term contracts to sign, and unlike a bank, it's unrestricted use of funds. There's no monthly reporting or margins and covenants that you have to follow. It's ideal for new startup companies, non-bankable businesses, and it does not require strong financial statements because you see, the factoring company makes their credit decisions based on 2 things: the creditworthiness of the customer and how long it takes for the customer to pay for their invoices. And unlike a bank, the financial strength, the financial wherewithal of your business is a non-issue. And there's no personal guarantees required. To get started follows a very simple process with limited paperwork, and I bet you would like to find out what your advance rates and discount fees would be. Step 1. Complete a short client profile and send this information back to the factor along with your customer list, a current AR aging report, and a copy of your articles of incorporation. The factor will come back to you within 24 to 48 hours with a term sheet, or some of them call it a proposal. This term sheet or proposal identifies your advance rates and discount fees. If those advance rates and discount fees fit into your business model, you will sign off on the term sheet or the proposal. The factor will complete their due diligence process and they'll set up your funding facility. This whole simple process takes just 3 to 5 business days to set up, and when your file has been set up, you usually can receive your money within 24 hours of creating that invoice. Now, I'm sure you can now see why accounts receivable funding, the factoring or the selling of a business's invoices, is becoming the alternative financing solution of choice. If you still have some questions, or you think you may need some help in getting started, 2 ways to get in touch with me personally. My phone number is 888-839-3863-FUND. That's 888-839-3863-FUND. Or you can email me directly at mikep, as in professional, at thetfi.com. That's Mike P, as in professional, at thetfi.com. This concludes the presentation. Thank you again for taking the time out of your busy day to join me here. I hope you enjoyed receiving this information as much as I did making it available to you. Bye for now.